I think that means we can start our conversation now.
Yeah, let's do it.
Great. So, welcome everybody to this panel. My name is William Robinson. I'll be managing and asking questions today while Yuan and Haseeb answer them to the best of their abilities. I've promised not to put them on the spot, but we'll see what I can get out of them. And we'll start with introductions just to make things, I think, clear who's talking and why. I'll start with myself. I've been at Alliance for the past 4 years. I'm currently the director there. We're an accelerator for Web3 startups. Before that, I was a forensic crypto auditor, and before that, I finished a PhD in game design. And I help teams fundraise from VCs at places like Dragonfly and Blockchain Capital. That's me. So, Haseeb, why don't you introduce yourself?
Yes, so I'm Haseeb. I'm managing partner at Dragonfly. We're a global crypto venture fund, been investing in the space since 2018. And we back startups all the way from seed stage to, Series A, Series B, and beyond.
And Yuan?
Hey everyone, I'm Yuan. I'm a partner at Balshan Capital. I've been with the team for about 4 years. Balshan Capital is one of the first venture funds in the world dedicated to investing in crypto and companies leveraging blockchain technology. And we invest from the seed stage to Series A, Series B, and Series C and beyond.
Fantastic. All right. First question's for you. So you became one of Blockchain Capital's youngest partners at 25. You bet your entire life on crypto. I want to know what gave you that conviction, and what brought you into this market to invest across all of these cycles.
Well, it's funny you asked that question because it was actually, about four years ago, it was actually Haseeb who gave me the advice and pushed me to drop out and commit full time to investing in crypto. I'm meant to be spending all my time in crypto.
That's true.
And Steve, I don't know if you remember, but at the
I
time
do.
I
I
was
do.
I
Of
was
course I
still
do.
yeah. I was still in school. I was studying computer science and philosophy at the University of Pennsylvania. But I was spending pretty much all my free time in crypto, like nights and weekends. I'd be reading white papers, messing around on chain, spending a ton of hours in Discord and just asking questions, learning. And to be honest, crypto was my passion. It was what I was passionate about, spending all my time there. And school was kind of a hindrance, right? And I think speaking to Haseeb, you know, gave me kind of the advice. He basically pushed me and convinced me that I could really accelerate my career by going all in on crypto, right? I was already so excited about it. Why was I wasting my time in school? And I think that little bit of a perspective shift after talking to Haseeb, I mean, it took a week or two for it to sink in, but like after going back to classes, after spending the summer basically working full time at Ocean Capital, as an intern, I realized that he was right. I was kind of wasting my time. And so I decided to basically drop out of school and go all in on crypto, right? And I think it was one of the best decisions I ever made. I wouldn't be where I am today in my career in crypto had I not taken Haseeb's advice. So I'm forever grateful for that. And I think, yeah,
Well, what was it
wouldn't be where I
about
am.
what was the thing
What
that
was
made
it?
you say this is special?
I think I think it was two things, right? For me, one, like I think the main thing was growing up in Hong Kong, and kind of as I was a teenager, I saw the political situation in Hong Kong radically change, just slowly every year. Hong Kong, throughout the late 20th century was one of the fastest growing economies in Asia. And I think one of the large reasons for that was because of the British common law system, right? If you're a business, you're doing business with China, you're setting up to invest or conduct business with other entities in Asia, you could trust Hong Kong's legal system and all the infrastructure that was there to basically fall back on, right? It was something you're familiar with, especially business in the West. And so everyone was coming to Hong Kong, and that kind of drove Hong Kong's economic growth, right? But I think as China sort of started encroaching on a lot of the rights and freedoms of Hong Kong, um, I kind of saw what these institutions that I personally believe to be very strong, they just slowly got eroded, right, bit by bit. And these institutions were not as strong as I thought they were. And so when I initially discovered crypto, I think back in 2017 during the ICO era, especially Ethereum, I saw, hey, it's this technology where you're basically building institutions that are in some sense similar to a court of law. They basically help adjudicate disputes between different people autonomously using code, math, cryptography, economics. And so this seemed like a much better institution to build, the businesses of the future, the protocols of the future, the internet of the future, right? And so I think sort of that experience and kind of discovering crypto, it just kind of it that was what red pilled me and caused me to, I guess, in school spend all my time on it.
Thanks. All right, I'm going to use two wild segues to get to my next question. You talked about going all in. Haseeb, former poker player. In order to play poker, you must be very good at human psychology. And now you can tell me how you think the cycles of greed and euphoria have been affecting your investment strategy over the past four cycles that you've been in. Are we in despair? What's going on next?
Well, so crypto, it's interesting because it's the most cyclical industry I've ever seen in my entire life. I'm sure there's been, back when I first came into the space full time in 2017, I remember a lot of people looking at what was happening during the ICO bubble and comparing it to previous bubbles in the past. So everyone used to compare it to the dot-com bubble. And then if you really had a sense of history, you were even comparing it to what happened at the advent of railroads, what happened at the advent of the automobile, what happened at the advent of the canal mania even further back, and railroad mania even further back than that. And so there's a lot of historical precedent for when a new technology galvanizes people, gets their imaginations going, and also incites some kind of financial mania. And crypto, the thing about it that's so weird and so unique is that it's not just once that it's done that. It's done that again and again and again. Now, almost always, whenever there's this kind of financial mania around some concept, it's a sign of two things. One, that people are really excited and they're getting ahead of their skis. But second, that the underlying technology is actually really, really important. Almost always when there's a financial mania, what you can see is that the thing that they're excited about, whether it's the automobile, whether it's the railroad, whether it's the internet, it's a huge generation shifting technology. It almost never happens that a financial mania happens around something that just doesn't matter at all. You saw the same thing happen with renewable energy in the green energy mania that happened just a couple of decades ago. But crypto is unique because I've never heard of this happening multiple times for the same technology. And it's a sign that there's something also unique about crypto itself, is that unlike any of these other financial manias, it is the substrate itself for its own speculation. That is the thing about it that's so new and so weird. It was a little bit true of the internet. They're like, okay, you could trade internet stocks on E-Trade, but crypto kind of jacks that up to 11. So because of that, it's really important as a crypto investor to always be able to be optimistic about the technology, understand where the technology is going, have some lived experience like Yuan Han was describing of just using these products yourself and living in the future the way that everybody who's in crypto has to have that ability to really understand what we're doing today. More and more people are going to be doing 5 years from now, 10 years from now. In the same way, early users of the internet, on some level, they were drawing the line out a little too quickly about how quickly the world was going to get online, but they were wrong. They were wrong in how quickly it would happen, but they were right that it would eventually happen, and it was true. The same thing that all the early internet adopters were doing, 10 years later, everybody in the world was doing. I think that's going to be true for crypto as well. We're already starting to see it in the amount of users that are coming on chain, the amount of TVL you see on chain, the amount of stablecoin adoption you're seeing around the world. All of those numbers are telling you that what we were all doing 5 years ago, the rest of the world is coming onto. It's just taking a little bit longer than it did for us to come on chain. But it will eventually happen. So as an investor, what does that mean for you? It means that, one, you have to be patient. You have to understand that it takes longer than you think. The standard mantra in Silicon Valley is that people tend to overestimate what can happen in 2 years, but underestimate what can happen in 10 years. And in crypto, that's overwhelmingly what my takeaway has been, is that when I first got into the space in 2017, everybody thought it was going to take 2 years. Everybody thought overnight the whole world is going to come on chain, crypto is going to eat everything, all assets are going to get tokenized, blah, blah, blah. And if you look back what happened in 2019, 2020, it was that, that did not happen that fast. But here we are, almost 10 years later, and you're seeing it happen now. And I think this is again one of the stories of crypto, is that you can't be too greedy, you can't be too impatient. You have to give the technology time, not just for the technology itself to become more robust, not just for users to gain trust, but also for the regulatory story, which again, crypto's been around for almost 20 years now that crypto's existed. And it was 2008 that Bitcoin initially launched. In 3 years, Bitcoin is going to be 20 years old. And yet we still have not had a single law passed in the US about crypto, which is bizarre for a technology that's this old at this point. And so what all that tells us is it's going to take more time for this industry to bake. Now, you ask the question right now, is this greed or is this fear that we see in the market? Again, it's an interesting moment because it's a combination of both of those things. You see enormous amounts of greed. We just saw Circle do their IPO earlier this week, and Circle, absolutely blockbuster IPO. Right now it's trading at an insane multiple in public markets. And that's now galvanizing a lot of activity happening on chain as well around the excitement around stablecoins. So I think you're seeing, and the same thing, look at the Coinbase multiple. Coinbase multiple is very high. All that is telling you that the public markets have a lot of demand. Bitcoin is near an all-time high. A lot of assets are doing extremely well. At the same time, a lot of other things are well, well below their all-time highs, right? So you see, Ethereum and Solana are both, about half of their all-time highs, and significantly below where they were just earlier this year. So you're seeing different things happening in different parts of the market. And I think what you'll continue to see is that the crypto market increasingly is not going to move as one entity. I think what you will see going forward is that the market is going to be there's going to be a lot more dispersion among different assets that behave very differently from each other. And so what happens in the meme coin market versus what happens in the alts versus what happens in Bitcoin versus what happens in public markets, you might see the four of those really differentiate into their own organisms that move very differently because they're different buyers and different liquidity dynamics in each of these different markets.
So I have a unique perspective on one of the markets, which is venture, because we have about 50 teams come out of Alliance a year looking to fundraise. And despite Bitcoin being quite high and these Circle IPOs doing so well, teams are having a harder time raising than they used to. And it's certainly not because we have worse ones. We have more and more teams applying to Alliance every cohort and a narrower and narrower margin to get in. So the sense here is that instead of term sheets being signed within, I don't know, 2 weeks, they're now getting signed at the 2-month range. And we're getting this sense that VCs are running out of the capital they used to have. My best guess is that they just raised a lot during the zero interest rate phenomena days from LPs, and that their returns have been poor. So not only have VCs done badly because prices as a whole have gone down, but in addition, LPs have less money than they used to. And so we're seeing a trickle down effect. But I was wondering if you could validate that from your perspectives or invalidate that. Certainly the time to diligence is longer than it used to be anyway. So I wanted your perspective on that from the founders out there who may be thinking about raising or fundraising and expect something more reasonable in 2025 than they would have gotten in 2022, for instance.
Yuan Han, you want to take a stab at that?
Yeah, I think Will, you bring up a great point, right? Like I think there's been a lot of dispersion across the venture market. Like I think whether it's early stage or later stage, I think especially at the later stage, it's even harder. I think the seed stage, it's still harder than say, 3, 4 years ago, right? I think you're absolutely right that a lot of funds, have underperformed and are struggling to raise their next fund, which I think, the effect is much more pronounced at the later stage, especially with generalists and some of the growth stage funds like Tiger, who are in the market back in the ZIRP era, leaving. I think it's also happening at the seed stage. But I think from what I'm seeing, even at the seed stage, yes, diligence timelines are taking longer. But I think for the best teams, they're still able to raise, right? And I think also for a lot of the best teams, there's still, in my opinion, a lack of discipline. I think for the absolute best teams, there's still plenty of seed funds out there who are very interested in backing them. And that often leads to valuations kind of going up and climbing. And then I think at the later stage, one of the reasons it's harder, not only is there, less capital than before, but I think because of this effect where you have this herd of seed capital funds, right? Seed funds trying to go after the few best teams, that pushes valuations up and means that the milestones those teams need to hit to raise their next round of funding uh, are just much more difficult to hit, right? And so I think, like you see it at the seed stage, but it gets even worse as you go to later and later stages where it's just much harder than before to raise money. Haseeb, I
What
don't
is
know, if you
Yeah.
guys are seeing the same thing.
how much less capital do you think there is? Like, what's your gut like percentage?
Uh, that's hard to gauge. I would say probably um 60 to 70% less capital would be my guess. It's hard to say because there's a few really big funds that kind of skew the average for the entire industry. And at once those funds turn over and they go raise their next vintage, and their next vintages are almost certainly going to be smaller than their ZIRP vintages. That's like the big reset for the industry from the top. Um, I'd say it's what you're describing is true, and I think this is true not just in crypto. This is true everywhere. This is true. You talk to YC, you go talk to, people who are even people who are in AI. Even a couple of years ago, the AI deals were getting funded much more easily than they are now. No, we're talking about the mega raises, people raising 500 million, $1 billion. Those are still happening, especially because of a lot of sovereign money coming into the AI world. But if you look at the early stage, it's a similar story, is that it used to be really easy for, a couple kids coming out of Stanford or Berkeley with a half-baked idea in AI to go raise $5 million. That's not happening anymore. And so this phenomenon is universal. And what happened in ZIRP is never coming back, right? That is unless we get some kind of financial crisis or something, and interest rates actually drop to zero again, we are not going back to that world. That world was a financial anomaly. It was a world where money was so cheap and money was so in search of risk that it was basically almost trivial for anybody with any half-baked idea to find a way to put money to work, no matter what the track record or the provenness of a particular financial opportunity was. That's what ZIRP meant. We're not in a ZIRP world anymore. We're in a world now where a lot of institutional LPs have a really, really strong counterfactual to their investment, which is to just hold, safe financial assets like bonds and treasuries. So that financial discipline is affecting everybody in the world. So crypto startups are not unique in that regard. And in a way, I think you should be looking at what's here as the new normal, right? Because the crypto market is actually, in objective terms, is not doing bad. You've seen a huge rebound in crypto asset prices relative to where they were at the beginning of last year. Obviously, things have gone up and down, and there's been some financial instability and macro instability that we've seen over the last year. And as I mentioned, we've seen even with something like Solana, it's down like half from peak to trough, even just this year alone. So there's definitely some movement, and that's going to be affecting how valuations flow through to seed rounds and Series A's and Series B's. But this idea that, well, it used to be that seed rounds would get done in like a week or a week and a half, and you'd have five different people bidding on, and getting in a bidding war over the average seed deal. I don't think that's coming back ever. It is a phenomenon, as Yuan Han mentioned, for very hot deals and for the very best founders. But the median deal being as aggressively picked over and moving as fast as it used to, I think that's the new normal, and founders should expect that to be the way that seed rounds work going forward.
Thanks. Yuan, I want to talk about your tokenized fund structure. So BCAP is semi-unique in the space in that it has a token, and you can buy it to get exposure to your fund. Now, when I joined crypto, that sounded like a regulatory nightmare, virtually impossible to do. Um, Surely there must be some strict limitations to what actually is going on there with this fund and what you can and cannot do with it. But I was wondering if you could just walk us through the mechanics and what you might have learned putting a fund on chain.
Sure, yeah. I think I'll start with kind of the story of how that fund came to be, and then I'll talk about some of the goals and then the mechanics. But back in 2017, during the ICO era, um, Boston Capital as a fund, we saw all these teams go out to raise these large ICOs. We were pretty skeptical, to be honest, of a lot of these ICOs. We didn't really participate in many of them. That we saw them as having weak fundamentals, and the valuations were just far too high relative to what we thought they deserved. But what was really interesting to us was the mechanism, that the ICOs were using, right? These teams could avoid going to venture capitalists, and they could raise from their communities, their users from around the world, right? Not just a small group of people with capital and access to capital we're able to raise now. And to us, we viewed that as potentially very disruptive, right? To venture capital as a business, to us as a business. And so we thought that we wanted to stay ahead of that possibility. And if venture capital was going to be disrupted, we wanted to be, at kind of the forefront of that ourselves, experimenting. And so, for our third fund, we decided to, as a proof of concept, to try out this tokenized fund structure. When we raised it, it was meant to, we raised a pretty small fund. It was a $10 million fund. It was also, I think, one of the first, if not the first, tokenized funds and security tokens in the world. And the goal at the time was we were hoping that through this kind of mechanism, we would be able to improve one, accessibility for investors who wanted access to venture as an asset class, but two, also improve liquidity, right? I think on the first goal, it was quite successful. We raised the fund in 18 minutes from investors, I think, spread around 75 countries around the world. We even have African LPs there, right, which I think is fairly uncommon for venture funds in general. But on the second fund, I think, Will, to your point, it was a lot more challenging, that being the liquidity part of it, right? We were hoping, hey, like by launching tokenized fund, LPs could trade it, maybe hopefully it'll trade at NAV or close to it, right? But I think it's proven to be much more of a challenge because of the regulatory uncertainty. I think Haseeb mentioned earlier, back in 2017, everyone thought, hey, like we're going to have laws, the institution is going to be here in 1 to 2 years, right? And here we are 6, 7, 8 years later, and we're finally, that's on the horizon, right? And so I think we've tried a few things over time to improve the liquidity side of the story. We moved the token to a layer 2 rather than being on mainnet to make it cheaper. But I think without additional regulatory clarity, it's very difficult for the infrastructure supporting trading of security tokens to improve. And so there's still a lot of paperwork, there's still a lot of mechanisms there that are just outdated that make it very hard to really fulfill the second goal that we were initially hoping to fulfill when we set out to raise our third fund.
Thanks, man. All right, I got one for both of you. At Alliance, we have every alum review every investor they ever get. And we've collected thousands of reviews of different VCs. And both of you have gotten very favorable reviews for the hands-on help you do with your founders. But it's not always clear what that means. And so I was going to ask each of you what you do to be value add so that your founders can tell other founders, hey, come take this guy's capital. He's going to move you move your chains. So yeah, are we talking whiteboards, intros, coaching sessions, therapy, something more esoteric? Let me know. How are you being a value positive contribution to your investments?
I'd
Also,
say, yeah, in my case, it depends a lot on the founder. It depends a lot on the team. Is that it's not really a one size fits all. There's a lot of stuff that Dragonfly as a platform. We support all of our founders with respect to, things like recruiting, regulatory, getting listed, figuring out your tokenomics if you're, very, very early and you're kind of pre having all that stuff figured out yet. At a partner level, a lot of the time, you support on whatever it is people need. So if they need some help with BD, they need introductions, they need this, they need that. But a lot of times, like the most valuable stuff that I do at our portfolios is mostly around like solving the really big problems that they're facing. And the really big problems can be problems of strategy, like positioning, branding, not realizing that the way in which they're telling their story isn't really resonating with the world and helping them to reposition their story. It can be a co-founder drama. Very often, one of the things that is actually most likely to kill startups is not failing to get product market fit or not having traction. It's just the team falling apart and just the human drama that naturally occurs when you have people who are, really butting heads and wanting to pull a startup into different directions. Sometimes it's marriage counseling. Sometimes it's helping them through some kind of nasty lawsuit. It's really it really runs the gamut. And so the places where I found historically that like when founders tell me, oh my God, Haseeb, you really saved this company, it's almost never like, oh, I help with the tokenomics or something. It's almost always like the real kind of human stuff that They call me in the middle of the night. There's some shit going down at a startup, and I'm there to help them out with it. We help with all the stuff, but the special touch that makes people really remember you is almost always the kind of the left field stuff that you really just need another human being to be there to help support you.
Yeah, I believe that. I've seen us have to break up co-founders, and that's like a really difficult and thorny task. And
Yeah,
you can only really trust your VC to do it, like as this third party who's like interested in the company's success more than anything.
that's right.
Okay, how about you, Yuan?
Yeah, no, I think both of you are hitting on a really great point here, right? Like I think at the end of the day, if I think about like for the founders I've worked with who have kind of hit the next level, right? And in our conversations after that, when we have, drinks or a chat, sometimes they tell me some of the most valuable things that I've helped them with or we have helped them with. There's often things that they were not aware of themselves, right? That they did not see on the horizon. They did not view it as a problem. And I think the most valuable thing that, we do when we work with the founders that we back is offering them that kind of perspective, right? We've been around, for many, many cycles. We were founded in 2013. So we know where the bodies are buried. We know all the mistakes that you might make as a founder that you might not even be aware you're making, right? Whether, it's refining your narrative to one that makes it more digestible to people, whether it's having the hard conversations that, hey, like maybe you guys need to add a co-founder with this expertise, or, you guys are not the best fit for each other, or it's like, hey, like maybe you guys should think of pivoting. I know you really believe in this, but it's really clear that the timing of what you're building is wrong, right? Having those hard conversations with them and basically having the perspective of having just been in the industry and having seen so many startups fail and succeed over time. That perspective is really, really valuable, I think, when we work with founders. Of course, we help them with hiring. We do a lot on the regulatory front. We spend a ton of time in DC, so we know, what's going on. Um, Happening, what's likely to get put into the bills. We help with marketing and PR. We run infrastructure. We help them with introductions when they want to do BD with one of our other portfolio companies or someone else in the space. But I think at the end of the day, like, the most valuable thing is what Haseeb's describing as kind of that personal touch, right? It's that advice that's, not one size fits all. It's like the pattern matching that you develop from having been a venture investor for a number of years, just having seen companies succeed and fail and what works and what doesn't. And the insight that you gain from seeing all of that and basically tailoring that to the founder and what they're working on at this moment in time and at this moment of their company's trajectory.
Great. Okay, all three of us have offices in New York City. And I think that Soho is pretty clearly turning into a crypto sandhill road. I walk down the street like, oh, there's Paradigm. Oh, there's Multicoin. Oh, there's BCAT. I mean, not everybody exactly on the same street, but we're getting a sense that if you want to take building your startup seriously, moving from rural Switzerland to New York City could be a good step. And at the same time, a lot of the problems that crypto needs to solve right now can't be solved from New York City. They have to be solved with like QR code payments in Indonesia, or money exchange houses in Colombia. And I think that we're seeing a global problem needing to be solved while at the same time having a clear crypto capital hub form. And I was wondering how you guys advise your startups around the geography of where to build your company or how to think about crypto as having a location or not. We'll start with Haseeb.
I think it's really hard to say that in 2025 it matters all that much where you are domiciled. Yeah, except like the tax and other stuff, obviously that matters. But it used to be pre-COVID, roughly 60 to 70% of all of our investments were in the Bay Area. After COVID, everybody scattered. You saw the rise of New York City as a hub. That's also when you started to see, Miami and Puerto Rico and these are sort of green shoots in different parts of the US. But even today, now that things have re-centralized, and you're absolutely right, New York City is the number one city for crypto in the world. It's still something like probably 30% of our founders are in New York. It's not the majority by any means. The vast majority of our founders are somewhere else. And that somewhere else could be some are in the Bay Area, some are in, Austin, some are in London, some are in, Singapore, and some of them are just in random places that you wouldn't think that a crypto startup ought to be. Because the reality is that crypto is extremely online. It's very global. As long as you have access to talent, you have the ability to hire. Um, it doesn't really matter where your people are. And I think especially this is going to become even more true with the rise of AI and the way in which it's going to enable smaller and smaller teams to be able to output the same amount of software. That is going to accelerate this trend that you're going to see more and more of this. In a way, what matters is not where you are physically, but rather where you are culturally and intellectually, right? It's really important that you are able to reach the people who are in New York. But you can reach them online because all of you, I spend more time online than I do spend in any office. And the same thing I think is true of almost everybody in this industry. And so in a way, it used to not be the case that if you really wanted to pitch quote unquote Sand Hill Road, you actually had to go take a flight down to San Francisco and go drive down to Palo Alto and go meet everybody in person. That's what it used to mean to go to Sand Hill Road and raise from VCs. Today, that's really not true. There's a lot of founders who are able to raise capital from all the big New York VCs without flying to New York City. And I think that again is a mainstay that in a post-COVID world, we're not going back to that.
Wait, how many of your checks have gone into teams you've never met in person?
A number of them. I'd say I don't know how to estimate. I'd
Okay,
say
but more than zero,
probably
which is crazy,
more
right?
than
To
zero. Yeah, I'd say
find
maybe like
checks someone you've never
10%.
met in person is remarkable.
Yeah, yeah. I mean, it's not the it's definitely rare. More often than not, we'll meet them in person. But I'd say something like probably 10% of founders we invest into, we haven't met in person. We meet them in person eventually, but we don't necessarily meet them in person in order to do the deal.
How are you, Yuan? What do you think about New York?
I mean, I think, I'll echo Haseeb's point, right? Like, I think we've also backed teams that we've never met in person. We might meet them in person at some point. Maybe we met them in person, a year ago at like a conference, right? Like crypto is also unique and you have these conferences that are pretty well attended precisely because the culture is so remote first. And I think at the end of the day, the things that matter most are, well, the reason why I think New York might be important is yes, there's a bunch of VCs here, but because there's also a bunch of teams that have some presence here, you can get deals done here, right? So on the BD front, and I think especially if you're maybe selling into the more institutional space, being in New York, you have maybe more of an advantage than if you were an SF, right? But I think if you were, say, building an AI, crypto AI, being an SF is probably going to be much more advantageous to you than being in New York because the quality of talent that you can hire who who's worked in AI before, who specialized in that they're going to be located in SF, right? But also we have teams, who are based in places like Africa, right? Because most of the customers are based there, right? They're working with stablecoin, payments, helping move, money in and out of Africa, and being local there matters much more to their business than actually having a presence in New York. Um, but I think we invest globally. Oftentimes we met the team in person, but there's also instances where we haven't before we make an investment, but we'll always meet them eventually. And I think whether or not you're in New York, crypto is so online that you don't really need to be here even to raise. But I think for a lot of companies, if you have deals to be done, having some presence in New York makes sense. It doesn't necessarily even have to be the founders, right? You could have team members here, especially as you get larger. But I think really at the end of the day, what's most important is can you hire and where are the people you're hiring? And also so many crypto orgs are remote first and they can access this global talent pool and have people located around the world and they make it work, right? And so, I don't think being in New York is at the end of the day that important, even though all the VCs are here.
Great. Um, so regulation is in flux is a polite way of saying crime is legal. Now, I don't think crime is legal, but certainly that's the meme. And we're changing the way that you can operate in the United States and in other places uh, due to recent political changes. And I think that's changing the risk appetite for founders. For a long time, we had founders who wouldn't even step foot in the United States because they were so scared. And also changing the kinds of projects people are open to building, though maybe not so much around privacy yet. But I'm wondering how this change in regulation has maybe changed your perspective on what's fundable or not fundable, or whether it's changed what you're excited to see people build or not, given that there's a new openness and a gray zone we're currently in that may close down into something different in a few months. Haseeb again.
I think, yeah, I'd say for most of the crypto VCs that you know and love, I don't think the present moment has really changed that much about their risk appetite with respect to investing into things that may be regulatorily more risky. Because the reality is that we've been funding regulatorily risky things the whole time. And the question is like, okay, why were we doing that before when there really was a sort of Damocles hanging over the industry? And I think the answer is that the crypto industry has always been kind of weirdly optimistic. It's true of founders, it's true of markets, it's true of like, the question of, why is it that funding rates in crypto have almost always been positive, even in bear markets? And the answer is because everybody in crypto is just really optimistic. Everybody in crypto just thinks that like, yeah, things are going to work out. That somehow like, yeah, okay, the regulator's going to realize, even in a Gary Gensler world, that no, my idea is really being done for the love of the game, and I really do believe that this is good for the world, and that if I can just get in the room with Gary Gensler, he's going to understand. A lot of people just genuinely believe that, right? Like you might ask the question, before the election, before Donald Trump came into office, um, the rise of New York City as an epicenter of crypto already started. It wasn't like, okay, now that Trump's elected, everyone can go to New York and like go be in this awesome city and go party. People were doing that in like 23 under Biden, under Gary Gensler. Why were they going to the place where you have the bit license, you have all the regulators, you have all the financial might that could bear down on the industry in basically the US government's backyard? Why? I think because, again, people were just kind of weirdly optimistic that they were going to be fine. I think that story is a big part of the reason why there's so much continuity, is that we've continued investing into things that even the prior administration has said, this stuff is totally illegal, this stuff cannot happen, DeFi, even things like meme coins. These things were right in the crosshairs of regulators. We didn't know at the time that all this stuff got funded, that, come just, 6 months ago, there would have been a jubilee for the entire industry. Now that's true. It's maybe true in principle that you can bet on weirder stuff, but if you've been betting on weird stuff the whole time, for me at least, it means that nothing really changes. It just becomes a lot easier for these companies to operate and cheaper for them to get off the ground. But were there ideas that were unfundable 6 months ago that are fundable now? It honestly difficult for me to really think of any.
That makes sense. How are you, Yuan?
I completely agree with Haseeb. I'll just add that I think the one thing that has changed as a result of the new administration, I don't want to say regulatory clarity because no bills have been passed yet, but this gray zone that's certainly much more optimistic than I think call it a year ago, is I think with this new regime that we're in, I think everyone can sense that institutions are a lot more excited, right? There's a bunch of people who maybe wouldn't have looked at crypto before who are now looking at crypto, whether they're fintechs, banks, financial institutions, or Web2 tech companies, right? And I think what that means is if you are building in crypto, I think from like a thesis point of view, what we're more excited to back and work with, to Steve's point, there's no ideas that we would back now that we wouldn't have backed maybe a year ago. But I do think one thing that has changed is how we prioritize things. I'll give you an example, right? Like I think because of this regulatory kind of call it sea change, this regime change, I think, and all these people entering into crypto and figuring out what they want to do, I think it makes having a very unique strategy to get distribution much more important, right? Especially with some of these people, right? Like because you have this wave of people coming online on chain, I think if you have a unique ability to basically go after them, or you have another unique insight that basically lets you go to market with a bunch of the people who are now coming on chain that maybe wouldn't have come on chain had we not gotten this regime shift. I think that's now a much more valuable kind of insight to have as a founder, and so it means that we might be more excited to work with certain founders who view things a little differently, or have a unique strategy or unique thought process with regards to some of these things than we would have a year ago had this not all happened. But I think in terms of ideas, like fundamentally what they're actually building, to Steve's point, I don't think there's anything that we wouldn't have backed a year ago that we would back now just because Donald Trump came to office.
Got it. Okay. So I think the people at Redefine wanted us to talk about long-term investors watching this, people trying to get some alpha out of this call, who are seeing this regulatory uncertainty, who are seeing these ups and downs and these booms and busts, which is the name of this panel. How do you mm, give advice to someone, which I don't know why you would be placed to give this financial advice, but I'm going to ask you anyway. Um, how do you give financial advice to people who want a dollar cost average and stay disciplined in volatile crypto markets?
Yuan,
Well,
why don't you take that one?
I'll start by saying this is not financial advice, right? I'm not giving financial advice here. But in my personal opinion, right, like I think none of us have a crystal ball. We don't know what's going to happen with macro. We don't know what's going to happen with interest rates. We don't know what's going to happen with tariffs, right? There could be any number of things that happen that make it very difficult to basically predict where prices are going to go, right? And so what I've personally always done is I've tried to just invest in things I have conviction in, I've done research into, and I dollar cost average, right? And when I think things are maybe a little overheated, I might dollar cost average to sell. When I think things are, people are maybe too scared, I dollar cost average to buy, right? That's personally how I've always approached it, and just focusing on things I've had long-term conviction in. But that's just how I've done it. It's my opinion. Definitely not financial advice. But yeah.
You gonna touch the
Yeah,
radioactive
it's
football?
so did you touch what?
Are you ready to touch the radioactive football? Which is the question
Oh,
I've.
yes. Yeah, hand it over. So I'll say, look, at the end of the day, we are VCs. We invest into private markets, and I think that's the place where we have the most alpha and the most insight. I think I'm pretty ready to admit I'm at the point now where I have no alpha in public markets, or at least not in terms of the majors, right? And I think if you asked me last year of, hey, what do you know that the market doesn't know? I said, okay, crypto's going to go up. Very clearly, this market is undervalued. People aren't paying enough attention to the fact that institutions are coming into the space. Stablecoins are going to continue to grow, and this is going to be one of the big financial stories of this decade. I think now the market gets that. I think that everybody in the world fucking gets that. There's no longer this informational arbitrage that I think I have from understanding the way in which market cycles have come and gone. I think now you've got BlackRock telling that same story. You've got Fidelity telling the same story. You've got PayPal, Stripe, all of them telling the same story. And you've got every financial institution in the world looking at how they're going to launch their own stablecoin. So the honest answer is that I think probably out of any time that I can remember as an investor, I think right now I have the least alpha of any time that I recall in the recent past. I still think my ability and the reason why we do what we do is that we can identify and win investments into the best and most promising startups. That's where my alpha is in terms of what I do as a VC. But in terms of public markets, I genuinely have no idea at this point where the cycle is going to end or begin, what are going to be the roadblocks on the way. If you think about it in objective terms, macro is really not that different than what it was at the beginning of this year. And yet you see alts are down about half of where they were at the beginning of where the cycle started. Why is that? I don't know. I really have at this point very little ability to explain what's happening in the kind of the macro picture of what's happening in crypto cycles. And so as for what I do myself personally, and once again, not financial advice, is dollar cost average in and just hold the assets. That's kind of it. The more cute you get, the more you try to time markets, the more you try to be really clever and having some complicated thesis. I've been in the space long enough to have seen many investors describe to me their very complicated thesis about this thing's going to happen and that thing's going to happen and this part of the cycle and that part of the cycle. And in retrospect, the answer was always just buy some. And at any given year, you go back, the most complicated theses all lost to the really simple thing, which is just own some crypto. Just do that and you'll be fine.
That seems about right. But you say that the whole world is now in on it, right? They all know crypto is the future, but it feels like they've been in on it before. And then when the price went down, they're just like, jokes, we fired that marketing team. We've never been on crypto ever. It feels like that could be around the corner again, right? Prices tank 80%, and Stripe looks the other way and says, we were never pro crypto to begin with. You don't think that's going to come for us? You think we're past that moment
I
where it's abandoning us?
I think there will absolutely come a time where crypto feels uncool and where crypto gets a bunch of egg on its face once again as an industry. Um, there's no alpha. There's no way that an industry can actually go up 2, 3, 4, 5x and not have the ability to go down another 50, 60%, right? There's no market that works that way. The volatility comes two-sided. And that's part of the reason why crypto is so difficult and why there's still money to be made is because there's still this ability to have enormous reputational ups and downs in, affiliating yourself with crypto. That being said, there's a lot of doors that are one way. And I think we've walked through some of these one-way doors already, which is that the US government now has crypto on the balance sheet. We have more and more countries around the world putting crypto on the balance sheet. We know that it's happening in many of the sovereigns in the Middle East. We know that it's happening in countries in Asia. It's just recently that we heard that Pakistan is now putting crypto on the balance sheet. More and more countries, this will just keep happening. More and more financial institutions, the big banks. We now have the BTC ETF is the fastest growing ETF in history. First to hit 70 billion, I think about a third as long as it took the second best ETF in history to hit this milestone. So these numbers, they're not going to get undone. But is there going to be another big scandal? Is there going to be another big drawdown? 100% there is. And this is
You
part of the
heard it
reason
here
why
first, folks. Big
you heard it
drawdown
here
coming.
first. No, look, at the end of the day, that's the only reason why there can be alpha in holding crypto is because, I used to ask myself this question is, at the end of the day, crypto is technology, it's software. Why is it the case that there's room for a dragonfly, a blockchain capital? And why is this whole industry not just going to get subsumed by the Sequoias of the world, the benchmarks of the world, the red points of the world, the founders funds? Why is it that there's even a role for somebody like us? And if you think about it, like that wasn't really true in AI. There's no AI native funds. There's no, for most of these technology trends, there's no chatbot native fund. There's no social media native fund. Overwhelmingly, these have been caught by all the big generalist technology funds because this is technology, right? What exactly is so different about this that requires a whole new set of investors? And I eventually realized what it was. The thing that gives us the right to exist and the right for this market to be actually dominated by crypto native specialists is because crypto will make you look stupid. Crypto will make you embarrassed. And the thing it is that we can stomach that the generalist investors cannot is the reputation damage. We've gone through years where crypto was the coolest thing in the world and we get invited to all the parties and we get all the Twitter followers and all the amplification and it's we get invited to all the podcasts. And then you get another 2 years where you don't get invited to any parties, where all your friends are embarrassed to know you, where you're no longer considered to have a high prestige career, right? And if you're a generalist VC, you cannot handle that. You cannot handle your LPs thinking that, oh my God, what did I do giving you my money? That's so embarrassing. But we can. And that is the thing that gives us the right to exist and is the reason why we've compounded these edges into now becoming in Super Bowl, where now the generalist VCs actually can't win the best crypto native deals. That I don't think we're done with that. We will eventually be done with that, but we're not done with that yet. And that's why I think this symmetrical upside and downside in the volatility of crypto is going to continue to exist at least for some time.
More embarrassment to come. I thought I had
That's right.
suffered.
Never.
Okay,
It's
great.
not over till it's over.
Oh my gosh. I think I lost. I mean, I was in the academy. Every academic I work with, totally embarrassed that I exist as a
Exactly.
crypto. All right. So, Yuan, as a representative of the crypto native generation, what would you tell TradFi professionals about building and preserving wealth across future crypto cycles to continue on our trend of advice for people? So, if you talk to these generalists or if you talk to these people outside of even VC, how do you think TradFi ought to think of and invest in crypto at this point?
Well, again, not financial advice, but I think what's maybe different now from even a few years ago is that I think I think it's a little easier for TradFi professionals to understand certain aspects of tokens that they might want to invest in, right? Like I think there's a much larger focus now from crypto projects to earn revenue, for that to be on chain, and for people to clearly be able to see, hey, how are they making money, and to basically attribute all of that on the transparent blockchain, right? And I think that's very unique. That means that every block you basically get an earnings report of a company or a protocol or an application, right? And I think for professionals, we're very used to valuing things based off fundamentals and cash flows and revenues. Uh, that's pretty easy to grok, right? I think a few years ago, that was very different. There was maybe, a handful, two or three protocols, projects that could claim that. Today, there's many, many more, right? And I think there's many, many more protocols and projects for whom that's become much more of a priority. And I think we're going to shift into this world very soon where I think it's going to be priority for everyone in crypto, right? And I think in that kind of a world, it's going to be a lot easier for people to understand crypto tokens and why some of them are valuable, why some of them are not valuable. Of course, I think you're still going to get, weird experiments. You're still going to get token mechanisms that are harder to grok and hard to reason about why it's valuable to someone who's not spending all of the time in crypto, right? But I think that is one shift that's happening that I think will make it a lot easier and a lot more accessible to people who are not crypto native to understand why some of these tokens are valuable, right? And so like that's one piece of it. Again, not financial advice, but I also think if you're not spending all your time in crypto, it's still a little hard to think about why some of these things might be valuable, right? Like, sure, you might see the revenue, you might see, them making tons of money every block, people flock to them, but I think a lot of these things, even the revenues are very, volatile. One month they might be printing money, and the next month they're not, right? And I think a lot of the use cases and what people are actually doing and why they're making money, they're also hard to understand unless you're spending all your time in crypto, right? And so I think there's also still definitely going to be edge from being crypto native and spending a lot of time using these applications yourself, figuring out how they work, why people are using them, what's popular, what's not, what is actually sustainable as a product that's always getting better. They're shipping fast compared to the other product that seems to be making money right now, but they're not innovating anymore, right? And they're not moving fast, they're not iterating, and they're being left behind by the market, right? I think you can't understand that without spending all your time in crypto. And even if you just look to the numbers, even if they're doing great this month, maybe next month, if you were spending all your time using the products, you would have already known, hey, these guys might be getting left behind and taken over by their competitor, who's right now not making as much money, but might make a lot more money in a few months' time, right? And so, I think one, it's easier to understand, but two, I also think unless you're spending all of your time in crypto, it's going to be pretty hard to basically, have alpha, right? And again, my advice would, again, not financial advice. It's not my advice. My personal opinion would be that because of that, I would probably still stick to majors, and the absolute most blue chip assets, and to stick to those rather than moving further down the long tail, even if the revenue numbers look really great.
Sure. Thanks. Okay. I wanted to change gears here and talk about what it is crypto is building. So, for a really long time, it feels like there's been one dominant app in crypto, which is pick which coin is going to grow faster than the other coins for the cheapest price, right? I'm racing Bitcoin versus Ethereum, choosing what to mine. Coinbase comes out, now I don't need to mine it, but I'm still picking which coin's going to go up. NFT craze on OpenSea, I'm just picking which coin's going to go up. Friend Tech, I'm picking which coin's going to go up. Pump Fund, which coin's going to go up. It's just a continuous casino on Mars, as some people call it, for a lot of people. Now, don't get me wrong, there are some stable coins out there and some payment rails that are revolutionizing finance, but it feels like the lion's share of attention and value being created is around this speculation, gamble-fi existence, what people call degen crypto. And it doesn't seem to be taking a smaller role as time goes on. It seems to be taking a bigger one. So I was wondering how you as VCs who fund these things square your, fiduciary duty to your LPs to make the most value possible by investing in the biggest successes possible. And your duty to yourselves and the world to invest in things that actually make the world a better place. And maybe casinos on Mars do. And maybe that's your philosophy on the world. So I'm happy to hear what you think you're doing as a contribution for future generations in fostering and allocating capital in the right places.
So
So I
I would
think,
dispute that story. Oh, sorry. Go ahead. Go ahead, Johan.
Oh yeah, please do.
uh, I'll just quickly start and say, yes, I think the use case of crypto thus far, well, one of them has been speculation, but I also would dispute that it's bad or negative, right? Like I think if you look at DeFi summer, that was almost entirely speculative. People were yield farming, crazy APYs, food coins. You look at them, why are these coins valuable? But if you look at stablecoin supply, before DeFi summer, I think, the number of stablecoins that were in existence was maybe 5, 10 billion. What was that used for? It was for people to move money around across centralized exchanges quickly. Again, speculation. But what did DeFi summer do? I think post DeFi summer, stablecoin supply ballooned, right, to north of 100 billion, north of 150, closer to 200 now, right? Maybe even surpassing that. I think what did that enable? That allowed people around the world who actually, needed access to US dollars to save, to beat inflation, to basically protect their family's wealth, to raise their kids and have a life and basically build wealth in a location where maybe they can't trust institutions that currently exist. That enabled that, right? And that wouldn't have happened without the speculation driving, the number of stablecoins in existence up. And I think because as more and more people start adopting, stable coins and some of these other use cases are less speculative, right? I think stable coins fundamentally have very strong network effects. And I think as more and more people adopt them, the DeFi infrastructure that thus far has been powering speculation can also start powering things that are not speculative, right? And I think as you add more and more nodes to this network, it becomes more and more useful to anyone else who joins this network. And at some point, maybe people want to do business with these people in developing countries. Companies start moving money around, and then the other companies in the West want to do business with them. And then suddenly the world's on chain, and before you know it, everyone's adopted DeFi. And it's not just serving a speculative, degen gambling. It's also serving very real use cases that are certainly helping people around the world live better lives and to help their families out.
Got it. So the take is YieldFi is to finance as pornography was to VCR. It's this sort of lascivious, not necessarily evil, but kind of icky thing that everybody's doing to push a technology forward for the better, is how I'm hearing it. Um, Haseeb, how about you? You said you were going to dispute the claim that, and I had
Yes.
a lot of them, so I want to hear which ones you want to dispute. If all, that's fine. Go
Well, so
ahead, please.
it sounded like the thrust of your story was that, look, the main thing happening in crypto is gambling, speculation, and that is only accelerating as crypto has gotten more mature. And I think this is just not true. If you look at the top 5 assets in crypto, they are Bitcoin, then Ethereum, then XRP, then BNB, then Sol. I'd say of those 5 assets, only one of them is primarily this sort of casino type activity that's galvanizing almost all the activity on the chain, which is Solana. And if you keep going down the list,
Wait, you say
you see
BNB?
more and more. Next on the list is Tron. I'm sorry,
Sorry, did you list BNB? I thought I heard you say
I
BNB.
did. Yes, BNB.
Is
Yeah.
that not part of the
Um,
same ecosystem of just speculating for fun?
No, no. I mean, BNB has existed as top 5 basically for like 5 years now. And like the rise of meme coins on BNB chain really happened, I don't know, a few months ago. But BNB chain has not driven its valuation that much because of meme coin activity. BNB chain, if anything, it's primarily the ecosystem for Binance. It's,
Right,
it's
but I
an
just mean
enormous ecosystem.
speculating
There's a lot of
generally.
TVL.
Finance exists for retail to
Well,
speculate and
if
raise
your
horses.
claim is that Binance is primarily about speculation, period. I mean, if you look at meme coins on Binance, right, or like Coinbase, right, if the claim is that, well, all these things do is speculation, then you're kind of assuming what you're setting out to prove, which is that the only reason why you would buy any of these assets is to speculate. I would claim that the reason why you're buying these assets is to invest. That's why people buy Bitcoin. That's why people buy Ethereum. That's why people buy Solana, right? You might buy a meme coin because you want to speculate. You might buy some long tail random, ICO that you've never heard of because you want to speculate because it might go up 500x or go to zero. But the casino, as you're describing, is like at the end of the day, if BlackRock comes into the game and is tokenizing these things and putting them on into ETFs so that institutions can buy them, I think that's the point at which you have to admit it's no longer speculating, it's investing.
Sure.
And for these assets, right, like the kind of volatility they have is high, but it's not really that high relative to a stock in the S&P 500. Actually, they're very comparable. If you just look at what Tesla stock does on any given day, it's probably more volatile than ETH is. So, so long story short, if you look at what's happening on Binance or Coinbase, you look at what's clearly speculation, right? Meme coin trading. It's about 25-30% of trading volumes is in meme coins, even for a Coinbase or a Binance. The vast majority of what people are buying and selling is technology. It's much closer to investing into tech stocks than it is going to casino and betting on the number 47 at the roulette wheel. So that's why I would say that this stuff is always there. It's never going to go away because it's human nature. But is that the main thing happening in crypto? I would say almost certainly not, right? Like Bitcoin dominance right now is at 65%. That means 65% of what's happening is just Bitcoin. Bitcoin alone, clearly, no longer really a speculative asset. And to say that everything else, I would say it's probably on the order of 30% of what's happening outside of Bitcoin is speculation. In which case, the number that I would arrive at is much closer to 20% of what's happening in the overall market, or 15% is gambling speculation. The rest of it needs to be explained some other way and has much more to do with DeFi, with stable coins, with technology innovation than it has to do with, okay, this is just a casino in the sky.
Great. Well, thanks for that. We have to wrap up. Our time is done. Thank you so much for all your answers to all my questions. I had a great time chatting with you, and I hope the viewers had an interesting time listening to you as well.
Thanks, Will.
Thank you
It was
all.
great.
My pleasure.